You've probably heard it 100 times before. Liquidity is key. But most traders still get stopped out right before the market takes off. In this episode of ComLucro channel, you'll learn exactly what liquidity really means from a smart money perspective, and how to use it to improve your entries, reduce losses, and unlock powerful risk-to-reward setups. We'll break down how liquidity grabs work, where to find them on the chart, and how to combine this concept with structure and trend to create a simple rule-based trading strategy. Let's get into it. So what is liquidity? Liquidity essentially means money. Every trade is an exchange between buyers and sellers. The more money flowing through the market, the easier it is for big players to execute large orders. Imagine a major company needing to convert hundreds of millions of dollars into euros. If they do it when liquidity is low, prices will soar. They want to avoid moving the market because their goal is to buy cheap. That's why they need liquidity. In other words, they need sellers in place. So the real question is, where is that liquidity hiding? Liquidity exists where retail traders enter the market. For example, if price reaches a demand zone, buyers step in. Not just retail, but also small banks, private institutions, and more. When they enter long positions, their stop losses are sell orders. That places the liquidity just below the demand zone, setting the perfect stage for big players to grab it, triggering a sharp move upward. Now, take a look at what happens up here. When price touches this trend line, it acts like support, and most traders will instinctively go long at that point. Naturally, they place their stop losses just below the trend line. That area underneath becomes a prime liquidity zone, and just below that, we have a major structure level, one that has recently acted as both support and resistance multiple times. So, if price pushes down into that level, it sets up a great opportunity to go long. Why? Because triggering those stop losses releases liquidity, and that liquidity often fuels the next leg of the trend. That's exactly the kind of setup we want to see. So what's the real benefit of identifying liquidity zones on your chart? Well, the first dig advantage is this. When there's a liquidity zone sitting right in front of a demand or supply area, it becomes an ideal trading opportunity. That liquidity acts like fuel. It's what powers the explosive moves we're looking to catch. The second benefit is all about precision. By understanding where liquidity is likely to get grabbed, you can start to separate weaker levels from stronger ones. This makes it easier to fine-tune your entries and avoid a lot of the losses that come from chasing the wrong zones. Now check this out. In this case, price broke through a key structure level with clear inefficiency, leaving behind a clean order block. If the market returns to fill that imbalance, that zone becomes a great place to look for buy entries. After that sharp move, the trend started to slow down, and you can actually see how price began forming multiple liquidity zones. Eventually, it broke below support, took out all the early buyers, grabbed the liquidity, and then launched to the upside. Now, here's a key point you really don't want to miss. When the market grabs liquidity right before hitting an order block, that's often one of the best setups you'll find. It creates the perfect conditions for a high probability trade. But let's be clear, this isn't some kind of rule carved in stone. Price can absolutely blow right through an order block and signal a much bigger trend shift. That's exactly why we always wait for some kind of reversal confirmation on the lower time frames before pulling the trigger. It's not about guessing, it's about reading the reaction. Now let's talk about where liquidity tends to show up on your charts. You'll find it in a bunch of places: trend lines, consolidations, even around big moving averages. But in our case, we like to keep things simple. So we mostly focus on equal highs and equal lows because they're obvious and they work. Take this example. It helps clarify how we separate real supply and demand zones from simple liquidity traps. Looking at the left side of the chart, we had a clean push to the upside, but it left behind an imbalance, a gap. In that case, we'd expect price to come back down, fill that gap, and hit the order block, which is where we'd be looking to get in. Then you see this opposite color candle creating another pocket of inefficiency, a textbook demand level. And right at the top, there's a structure zone that has acted as both support and resistance more than once. That's another prime area to look for buys. These aren't random levels. They're zones with logic and structure behind them. Now that you've got a solid grasp on how liquidity works and why it matters, let's jump into the actual strategy, step by step. But real quick, if this content has been helpful so far, take a second to hit the like button and subscribe to the ComLucro channel. It really helps us keep the videos coming. Alright, now let's get into the setup itself. The great thing is, it's super simple, and it works across all time frames. Forex, crypto, stocks, you name it. And it all comes down to just 2 key steps. Alright, so let's break down the actual setup step by step. Step 1 is identifying the trend, and for that, we use the 50 EMA. It's simple. Just drop the EMA on your chart and look for price to break through it in one direction. After that, you want to see 3 moves in the same direction, and on the third move, price should break a previous structure level. Let me give you an example. Say price breaks the 50 EMA to the upside. Then it makes 1, 2, 3 moves, with the third one breaking structure. That confirms we're in a bullish trend. As long as price stays above the most recent higher low, we'll only be looking for buying opportunities. Step 2 is spotting a liquidity sweep. That means we wait for price to form some kind of support, and then either wick below that level and snap back, or close below and immediately recover. Take a look at this setup. Price created support, then dipped below it with a long wick candlestick, grabbing liquidity. In that case, you've got 2 entry options. You can either jump in right after the wick, or wait for a confirmation candle to close above the previous one. Your stop goes just under the wick, and your target is the next structure level above. And here's a smart risk management tip. Once price reaches a 1 to 2 risk reward, you can lock in break even by closing half the position. That way, you're protected and still in the game. But there's something really important here. Always zoom out and check the higher time frame before placing any trade. You want to see where price is sitting and how much room it has to move toward the next structure level. For example, in this exact setup, if you zoom out to the 1-hour chart, you'll see that price recently broke structure to the upside, and there's plenty of space above for the trend to continue. That gives your trade real potential. Now on the flip side, if price breaks the higher low to the downside, that's your signal to shift bias. In that case, we'll look for short setups on the lower time frames, again, targeting the next key structure level. And just to be clear, everything we've discussed so far also applies perfectly in a bearish scenario. So let's look at a bearish example to tie it all together. Here on the Euro-Dollar 15-minute chart, the market broke below the 50 EMA, then gave us 1, 2, 3 moves, confirming our bearish bias. After that, price formed a short-term resistance, then broke above it, triggering stop losses and grabbing liquidity, only to snap right back down into the range. That's what we call a failed breakout, and it's exactly the kind of setup we want to catch. That's our trigger to enter the trade. Just like before, we're using structure, liquidity, and confirmation, all working together. And remember, this strategy isn't locked to any specific time frame or trading session. It works across markets, forex, crypto, stocks, but it's up to you to backtest it and see where it performs best. Every pair has its own rhythm, so find the ones that fit your style. But no strategy can perform without one critical factor: discipline. And to dive deeper into that, we want to share a quick but powerful segment from one of our internal training videos. It's called Discipline, Patience, and Consistency, the Trader's Real Edge, and it's part of our Psychology and Trading course here at ComLucro. We'll leave the full link in the description if you want to watch it later. But here's a short preview. Let's start with one of the hardest lessons in trading: discipline. Discipline isn't about being perfect. It's about training yourself to follow the process, even when every emotion in you wants to do the opposite. Think of it like a muscle. If you don't use it, it stays weak. But every time you respect your stop, stick to your position size, or follow your checklist, that muscle gets stronger. It's what separates consistent traders from impulsive ones. Without it, no strategy survives. With it, even a simple plan can protect and grow your capital. A disciplined trader doesn't wake up wondering, do I feel like following my rules today? He just does it, because discipline has become part of who he is. Now here's a powerful take on this from David Paul, someone who has helped hundreds of traders build the mindset needed to succeed.
I think that you can build discipline in any field that you want to sort of work at. It takes repetition, I go to the gym every day. I have absolutely no idea why I go to the gym every day at 61, but nevertheless, it doesn't take any discipline for me to go to the gym every single day. And the great paradox, of course, is that when you've got discipline, you don't need it. So it just happens. You can build discipline relatively easily. And in some of the training courses I've done over the years, we have a discipline building exercise, which is all about gritting your teeth and following a trading system for about 30 trades. It takes about 30 trades to instill that discipline. And I'm reasonably disciplined in most things. There are certainly things that I need to work on, that's for sure. But I firmly believe that anybody can develop the discipline to be a consistently winning trader, but very few do.
Discipline isn't something you wait to feel. It's something you build. And once it becomes second nature, it turns into your greatest edge. And that's exactly the mission of ComLucro. Our goal is to give traders the knowledge they need to make better decisions in the market. Every video, every course, and every piece of content we share is built with that in mind. Clear, practical information that helps you grow step by step as a trader. On this channel, you'll also find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading is not just about the charts, it's also about how you think and how you manage risk. We also bring lessons and insights from world-class traders and coaches like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others who have shaped the way we understand the markets. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro Trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.